The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
So today we're going to do a little reflection on the markets. People are confused. There's clearly confusion in the market among retail investors, institutional investors less so. If you ask them their opinion about where we're headed into 2024, we find division much as we did back at the end of the great financial collapse in March of 2009 when the market bottomed. There was confusion among institutional money managers. Retail investors were pretty much decided. It was a bear market and it wasn't over. There was a lot more money to lose. And
things were bad, but it was going to get worse.
After having gone through the tech bubble collapse just a few years earlier, retail investors were not excited about buying low anymore. Buying the dip didn't look like the fun it was supposed to be because we hadn't seen any highs.
We say that all the time. We talk about when things are down, when things are low, you never know how far down can be. And so if you're feeling particularly burned at the time, you're going to feel like, nope, this is going to get lower. Even though you may see some signs of recovery, you never buy into them as being the kind that's going to turn the market around. It's just a quick little bounce, and we're going to continue down here. And that was definitely the feeling back in 2010. No one was ready to say, this market's about to take off and not look back for a decade. Everyone was still, no, we have more downside left here.
Well, and if you look at the way the market is divided in its performance, with the concentration in the S&P 7 or the Magnificent 7, or you look at the S&P 10 leaders, there's just an abnormal span in returns between the top 10 stocks and everything else in the market. It's not that if you're a stock picker, you can't go do a lot of research and find something, but most people are oriented towards the index performance, and so are most mutual funds and exchange traded funds. They have a target or a performance benchmark that's closely related to one of the major indices, typically the NASDAQ or the S&P. There aren't very many funds that try to track the Dow Jones anymore. It no longer represents the economy.
A lot of touch right now, yeah.
But just think back where you were in 2011, looking over your shoulder, a little hindsight examination. Do you remember what your attitude was about investing at the time? Particularly if you are pre-retirement or boomer, you probably were invested in the tech bubble collapse and probably walked it all the way to the bottom. And here we were in 2007, and we hadn't had full recovery, and then we get another 50% drop in the S&P. How did you feel at the time, and how does that relate to how you feel today? Is there any similarity in that?
Yeah.
The data suggests there is.
The way you feel, what did you do? What did you do? And that's where the rubber meets the road in investing. The way you feel about things can color what you're thinking about, but what do you actually do? And back then, there were way too many people, because of what had happened previously, because of the GFC, because of the great financial crisis had just hit. Massive losses had been incurred across the board, and when things got better, no one would believe it. Even though they were looking at the numbers and saying, yeah, things are getting better here. I'm just looking at the numbers right here. In 2010, the S&P was up 12.8%. But in 2011, the S&P was essentially flat. It was up 2%. And in 2011, that was it. Here we go again. The rally's over. This is going to collapse. Everything is, we're just about to take the loss again. We got to get out of this market. We never should have been back in at all. Everything's terrible. And of course, the market was about to take off for a 10-year bull run. And and if you sat there in cash, you missed it. And at the beginning, of course, it took off like crazy. That's where some of the biggest gains were. But even if you were looking at that data that said things are improving, you could not talk yourself into actually making the move, actually moving that money off the sidelines and back into the market because, hey, this is just a dead cat bounce. This is no good. And now 2011 is verifying this is not going to keep going up. We're in big trouble here. Wasn't the case at all, but it sure felt that way.
Inflation was rising. It was going to turn into hyperinflation. That was going to destroy the economy. The
Yep.
Fed was intervening in the markets, which they were then and they still are today. In fact, their intervention has accelerated. People were looking for the price earnings ratios to drop back down into single digits. And you can find some of those today, but the odds are very good that they might be on the NASDAQ's list of companies about ready to get delisted because the share price is under $1.
On the edge, yeah.
You have to maintain a dollar share price in order to stay listed on the NASDAQ exchange. And then we had quantitative easing. So that was actually helping the economy along. And it wasn't too severe at the time, but COVID came and it got worse, expanded
Right.
beyond anybody's imagination. And with that, Congress decided that they needed to spend a ton of money since they told you couldn't go to work anymore and you needed something to buy groceries. So if you were a favorite of the policies of the party in power, you still got to operate your business, but most of them had difficulties. And those are close to our memory. That's not that far back. And we're sitting here looking at until the last week of November, we're looking at a market that has a lot of signs of ongoing struggle, much as what we saw at the bottom of the market in '09. The arguments, as you just said, were real at the time. And today we have some similarities with the tech bubble. When we look at the price earnings on the major stocks, let's call them the S&P 7 or the tech bubble, the companies were different. I think it was the top 6 at the time. But the PE ratios are extremely extended, and waiting for a single digit PE may not happen in your lifetime.
That's a long wait, looks like. That's right.
So there are a lot of scenarios of disaster. And one of the ones which leads to some confusion is the administration continues to tell us, as does Chairman Powell, that we should have a soft landing. What's a soft landing? Soft landing, a recession. People out of work, so unemployment's rising. That means your household income drops. That means spending drop. When spending drops, sales drop and profits drop.
Right.
So what am I supposed to do now when the market keeps going up? Well, this is back to our basic mantra as money managers, and that is buy leaders, and when they quit leading, get rid of them. Buy and hold is not a safe investment strategy, but it is the one that keeps mutual funds, exchange traded funds, and money managers holding assets for clients. We don't want you to sell. You should never sell. You should just always hang on and wait for it to come back, because it will, except not every company comes back. There are times.
And that's the truth. Yeah. They want you to never sell. That's the idea. It's like, don't ever make that decision, because you never know when the markets are going to turn. And that part's true. No one does. But you get a lot of indications about when markets turn, and is this a broad turn? Is the economy doing well? Are lots of stocks doing well? Is it a handful of stocks? You always get that data. You have to have the courage to act on it. You have to have the confidence to say, I understand the way markets work. And even though I'm not necessarily wanting to do this right now, it's what it needs to happen. And that's where you need to get. That's what we do at Investor Resources. When we see that market turn, when we see the data change, I cannot count how many times Don and I have looked at each other and said, man, I don't want to buy that. That doesn't seem like it's a good idea. But everything says right now, you should buy that. 9 times out of 10, that turns out to be where you should be. If you listen to the market will tell you what's going on, but you have to pay attention. You have to listen, and then you have to be disciplined enough to actually act. Because when you get right down to it, how you feel about it doesn't make any difference. What do you do about it? That's the only part that matters. And unless you can make that decision and make that investment to get in the market, or understand that, this rally may be over. It's time to start lightening up and pull things out of the market. You have to be willing to do that. And no one's going to be right all the time. But if you listen to the data, if you track the data, that's going to get you on the right side of those trades most of the time. And that's really the best you can hope for.
Well, we harp on this all the time, that risk is not in you, because the market doesn't know who you are, doesn't care about you, doesn't know when you're going to retire or if you're going to retire, doesn't know if you have to put kids through college. It doesn't know anything about you, and it does not care. Risk is in the market, and you need either to do this yourself or hire somebody to monitor what's going in the market. And when you read the charts and you see prices are rising in given sectors, you want to own those sectors. That doesn't mean you should hang on to sectors for diversification when they're losing money. You just simply need to have a process that says, this is the time to do this, and this is the time to do that.